For the 20-odd years, Google had this perfect business. The beauty of this business model is that it did not have to spend. One more search cost almost nothing. No extra factory, no new machines to replace every year. But then, last quarter, Sundar Pichai, the man behind the machine, decided that selling answers is no longer fun. For the very first time since its founding, after 87 consecutive quarters of cash generation, Alphabet has a negative cash flow. Pichai placed a $200 billion bet on building the shovels for AI, saying chips, servers, and data centers. And he also says the spending will rise to an even more stunning level again next year. Immediately, this triggered a sell-off. But the deeper problem is not the stock price, it's that Google may be changing the economics of its entire business. So in this one, I will answer the following questions. First, how did Google redeem itself from being an AI underdog? What is Google becoming? How real is Gemini's demand? Is the overall AI demand even real? And what to watch next. But let's start with a little bit of drama. After 3 years of being an AI underdog, just 3 years ago, Sundar Pichai put a cold red on ChatGPT. Because ChatGPT was one of the first firms that has reached 100 million users in the shortest amount of time. And the first time in 20 years, it's these challenges that may actually replace search. While Google had the most established AI lab, the data, the users, etc., the moment ChatGPT was released, it suddenly looked slow, confused, and late to the party. Even though Pichai explains that he didn't say cold red, the fact that he had to clarify is just everything you need to know. Pichai then spends the years that followed carefully steer this ship on a brutal AI roadmap. From year 2022 and onwards, they have released some really stunning AI products. Think Nano Banana's search assistant, Gemini business, or new generation of TPUs and more data centers. With all his hard work, finally, in the late 2025, the table flipped. By the way, don't hoard knowledge because it isn't good for your karma. In late 2025, Sam Altman sent his own cold red memo. Because Gemini had become the serious threat to OpenAI, he even delayed some of the other plans just to focus on fighting Gemini. For Google, this was supposed to be the rebirth because Underdog now finally earned the recognition from its biggest rival. Here are Google's wins that is celebrated in its latest earnings. Search revenue grew, same as the YouTube ad revenue. And then there was the cloud, up even 82%, a serious acceleration. This 82% matters because Google Cloud was already enormous. Assuming that Google Cloud sustains its current quarterly run rate, it has added the equivalent of 45 billion a year business in just one single year. More revenue than a Starbucks could generate in the whole 2025. But this is not all unicorns and rainbows. The investors actually smelled something wrong. In particular, the kind of companies that they see Alphabet is becoming. Conclusion first, 2 things. First, from search heavy to AI and cloud. Second, from capital light to real capital intense. This is its segment revenue trend between 2023 and 25. Search was the main revenue, as you can see, and it was still free cash flow positive. However, this trend is clearer. Starting in 2025, its capex has increased dramatically to the point that people wonder whether it is now becoming an infrastructure company with negative free cash flow. In year 2023, Google spent about 10 cents on data center and chips for every dollar that it made via search and other products. In 2025, it became 23 cents per dollar. And this year, in year 2026, it could become spending 40 cents on AI and data center infrastructure versus $1 it made. This all means that Google still made most of its money from ads, but now it spends like a company that needs giant factories to grow. That's why investors are getting nervous, because building infrastructure costs money long before you know whether the products coming out of them will pay for themselves. Besides, the lifetime of that capex is also an issue. Spending $200 billion on GPU that are realistically useless in 3 years is very different than spending $200 billion on CPU that could be written off over a much longer lifetime. Once the data centers are built, how often do they need to refresh the GPU? Is it now forever burning $100 billion in capex just to renew the GPUs? This brings us to the depreciation accounting game that they've been playing. The whole AI boom may come down to one extremely boring question. How long can GPU really make money? Many people believe that after 2 to 3 years, actually Google initially said 4, a GPU may no longer be good enough for the most valuable AI work. So if Google has to replace it in order to keep up to the most frontier AI labs, but still only depreciate it over 6 years, this creates a serious accounting loophole. The issue has twofold. Issue number one, think of two identical laptops. One sits in an office handling emails, slides, and web browsing for 4 years, all fairly lightweight tasks. The other one runs a Bitcoin miner at full power day and night. Both laptops may still be able to turn on for another 2 years, but the second one had a much harder life. And that's exactly the same question for AI chips. An advanced GPU used consistently for frontier model training may not have the same economic life as one running lighter inference or batch jobs. Of course, there's also this optimistic case that old GPUs just move down the ladder and to do some lighter jobs from the frontier model training to run some cheaper models and internal workloads. But a chip being usable is not the same as chip earning enough money. Issue number two, profits depend on how long Google says a GPU lasts. Yes, you heard it right, not how long it actually lasts. This is where its capex issue comes in, and one of the reasons why investors are so worried about it. Even if Google can keep old GPU running, it still needs to buy new ones every 2 or 3 years in order to maintain Gemini's competitiveness. This means the question now becomes, how much must it keep spending? How often should it replace the machine at the frontier? And how should its accounting practice change accordingly? Imagine a cab company buys a $16,000 car. If it expects to use the cab for 4 years, it records a $15,000 cost per year in its accountings. If it decides the same cab will actually last for 6 years instead of 4, then it will record only $10,000 per year in spending. But that results in two very different accounting profits for the exact same $12,000 presumably in revenue from driving customers. If the cost is $15,000 per year, then the profit of that $12,000 revenue is now a net loss of $3,000. But if the cab company decided to depreciate the cab for over 6 years, they will have made $2,000 in profit per year. So Alphabet, for the last 3 years, may already be playing the exact same number of games, just with a few more zeros. We completed an assessment of useful lives of our servers and network equipment and adjusted the estimated useful life of our servers now from 4 years to 6 years. The change reduced that year's depreciation expense by $3.9 billion and lifted the net income by $3 billion. That makes the business more profitable than it actually is. So the question about its AI and cloud ops is whether Google can really keep it busy at a profitable price for 6 years. So that was cloud infrastructure. What about its AI model, Gemini? Oh, by the way, if this is one of those videos that with substance that you finally found after a long time, feel free to subscribe. Now, how real is Gemini demand? For 3 consecutive quarters, Sundar Pichai disclosed a growth rate of generative AI product revenue. In Q3 2025, he said revenue from products built on our generative AI models grew more than 200% year on year. And then 400% in Q4 2025, and then even more impressive of 800% year on year in Q1 2026. That's quite impressive, but he never talked about the baseline number. Now, I want you to think someone running a lemonade stand. In his first year, only his mom buys a glass, so he makes $1. The next year, he's dad because the mom asked him to, and a neighbor each get a glass too. Brings his total to $3. He then proudly tells the whole neighborhood that our sales skyrocketed by 200% year on year, since going from $1 to $3 really is a 200% boost. But he conveniently leaves out the fact he started with a single dog. That is why not showing the baseline can mean genuine success, though more often than not, especially when you never talk about the baseline, it just means that you started with almost nothing. Then, this time, in his Q2 2026 earnings call, Pichai changed his tactic. This time, he emphasized 22 billion tokens per minute and the 950 million monthly active users. While the numbers still sound big and outstanding, they are, again, not a proof that Gemini is generating revenue. Gemini is placed in front of almost every search engine and Android users. These two metrics may perfectly reflect the interactions with a free trial rather than the users actually willingly paying for its AI product. So until now, we only know some people are using Gemini, and even some of that might be forced on them, but we don't know how much that usage is paid for and profitable. Well, what about cloud demand? Maybe it gives us a clearer answer. How real is the cloud demand? No one can yet explain the full economics of AI build-out. For example, the arrangement with Anthropic and similar cases makes it especially difficult. Alphabet has committed up to $40 billion to Anthropic. Anthropic has, in return, agreed to use Google's TPUs and Google's cloud capacity. Now, let me try with this scenario. I want you to imagine this. There is a propane company called Google with 4 O's. Claudius owns a crematorium, but it does not yet have enough money to buy fuel to burn much of anything. Out of kindness of their heart, Google gives Claudius $30 billion on credit for Claudius to buy propane from Google to burn some bodies. Google then announced demand for propane has exploded, yay, which is technically true. The propane is real, same as that $30 billion in revenue. There may be even plenty of dead people. However, the question is whether there are enough paying funerals to justify that $30 billion of propane, or whether Google just has financed its own best customers. This hands money from your left hand to your right has a name, circular deal. Now, back to Google. Since the public disclosure do not tell us how much of Google's demand is funded by Google. So you can't really blame investors for worrying how much of this real demand comes from the outside world or how much is it Google's own money making the factory look busy. But here's the more fundamental issues with the entire AI ecosystem. How real is the AI demand? Both the AI circular deals and the Gemini user numbers lead to the same but a much more profound question. How real is the AI's demands to justify this $100 billion market? I'm not doubting if there's anybody using AI. Of course there are. Just think how many times that you secretly asking AI to summarize my work without engaging it. Joking aside, 5 clues that no one has figured out if AI is even a net positive investment. I'm going to include this piece of leaked Morgan Stanley's internal report and also other materials to help explain these clues. Clue number 1. We're still far from seeing profit in AI. In this Morgan Stanley report, it first says, enterprise first spend money modernizing data centers and getting ready. That's where we're at. And the productivity boost, for example, development automation, like replacing developers, only arrives later. And even then, monetizing depends on the companies finding a new way to charge for it. So that Google's 82% of cloud growth may be real. But this is still the stage where the companies are buying the plumbing before they have the proof that the house is even worth building. Companies are beginning to scrutinize token spending, especially in prototypes, agent workflows, and code that never reaches production. Also, they're stepping away from using the expensive model for every task. Instead, companies route simple works to cheaper models and reserve the frontier models for high-value ones, which arguably only a handful of companies that really need to use a frontier model to boost their workflow. And this is why that 22 billion tokens per minute and that 900-something millions of Gemini active users are not enough. because they only show activity. Activity isn't equals to money. Gartner reaches a really similar awkward conclusion. Customers have stalled on basic AI uses. Pichai also emphasized that over $500 billion of cloud backlog proves that customers are ordering capacity. It actually doesn't, however, tell us how quickly that backlog turns into revenue, what margin Google earns based on that backlog, and how much is hardware rather than software, or how much of that demand is ultimately funded by Google themselves. Key number 4, the hidden risk is commoditization. In that Morgan Stanley report, it also says that the cost of reaching a fixed level of intelligence is falling by roughly 5 to 10 times every year. It also points to the rapid growth of open weight model. What is worse is the birth of Kimi K3. The choice is no longer dumb but open or smart while closed. Kimi K3 is both smart and open, as I said in my Kimi K3 video. On top of this, if anything, 2026 is the AI routing war. Even the traditionally payment companies that you don't view as an AI company want a piece of the AI routing pie, indicating no one cares which model, but only the outcome. AI's intelligence is worthless unless the fundamental flaws of large language models are one day corrected. Otherwise, this trend will continue. So where does it put Gemini? The question is, can revenue grow faster than power depreciation and the data center cost? Basically, for Google, it will all be about whether it can make money selling what they bet on. $200 billion and more. By the way, before we continue, if you know someone who needs a reality check about AI, be a friend and share this video with them. Now, the major AI and semiconductor stocks have experienced this massive gain in the first half of 2026, followed by a noticeable decline in July. And it's clear that the market has concerns about the current value of these companies, because keep in mind, the issues I pointed out aren't Google's alone. The rest are different to some degree, but all runs very similar business model. Here's the credit spread, which is a measure of how risky investors think that is. Higher spreads means higher risk. So if you compare the Google spreads with Microsoft ones, it's really clear that Google's investors have already lost their faith in the whole management team and their latest AI strategy. From what I see, these AI companies, in this case, Google, have two choices here. Either they keep AI folded within cloud and ask investors to trust that Google's growth reflects healthy AI economics, or it can disclose AI revenue and state margins separately and bring it all under daylight. From my view, disclosure, of course, is a better approach, I think also for a lot of investors, but it's also a risky move, a move that no AI company dares to try yet. Next week, I'm going to compare Google's strategy with Microsoft's, because Microsoft's earnings only coming out this one, to see how the market treats these two somewhat similar businesses very differently. Well, don't forget to subscribe and watch this one next.